Imagine spotting hidden stock gems before anyone else does. In One Up on Wall Street, renowned investor Peter Lynch reveals how to outsmart the market with strategies that work for both novice and seasoned investors alike. Ready to grow your wealth and master the stock market? Investing in the stock market doesn't have to be a guessing game. With Peter Lynch's timeless strategies, you can learn to spot opportunities, build a solid portfolio, and avoid the traps that trip up so many investors. Whether you're a first-time investor or looking to refine your skills, this audiobook will guide you through the art of identifying promising stocks, making smart decisions, and understanding market movements. Get ready to discover how to turn everyday insights into extraordinary returns. Focus points. Investing in fast growers. Know when to seize the opportunity and when to get out. Slow growers as a safe bet. Understand why steady, slow-growing companies may offer more security in your portfolio. Stalwarts for stability. Learn why these stable stocks can bring peace of mind to your investments. Profit in volatility. Why the most profitable stocks often come with big ups and downs, and how to take advantage of that. Turnarounds. Discover how investments that start off poorly can become massive success stories. The dark horse strategy. Become a wise investor by finding and sticking with those hidden stock gems that others overlook. Portfolio building tips. Create a stock portfolio that maximizes returns while minimizing risk. Learning outcomes. Master how to identify stocks with the most growth potential. Gain insights into when to buy and when to sell, especially in volatile markets. Learn how to build a balanced portfolio with a mix of fast growers, slow and steady stocks, and stalwarts. Understand how to recognize opportunities in both emerging stocks and companies that are bouncing back from a rocky start. Avoid common investing mistakes and navigate the stock market with confidence and clarity. Get ready to take your investing skills to the next level and one up on Wall Street. Focus point 1. The cautionary tale of fast growers, knowing when to exit. Investing in fast-growing companies can seem like a golden opportunity to boost your portfolio. These are typically small companies that experience a rapid surge in growth, often reaching impressive rates of 25% or more in their early stages. Naturally, the allure is strong, the chance to invest early in a company that could skyrocket in value. However, while the rewards can be high, the risks are equally significant. The key to successfully investing in fast growers lies not just in recognizing their potential, but also in knowing when to pull back. The explosive growth of these companies is often unsustainable, and without careful evaluation, an investor can find themselves holding onto a sinking ship. Before jumping in, it's essential to scrutinize the company's growth trajectory. Ask yourself whether the growth rate has been consistent or if it's a short-term spike that may not be sustainable. A critical aspect to assess is whether the company's main product or service is integral to the business's success, or if it's simply a flashy front that distracts from underlying weaknesses in other parts of the business. You also need to evaluate whether the company's success is a one-off or part of a broader, long-term growth plan. The goal is to determine if there's genuine potential for the company to expand and sustain its growth over time. One valuable method to evaluate these opportunities is the price-to-earnings growth, PEG ratio. This analysis helps determine whether the company's price is justified by its expected growth rate, offering a clearer picture of whether the fast growth is legitimate or speculative. Despite the enticing potential, investing in fast growers requires a balanced approach. It's tempting to go all in, but it's wiser to diversify and avoid putting your entire portfolio at risk. The unfortunate truth is that while these companies often begin with impressive growth, they can suddenly falter, causing a significant loss in value. The key is to maintain discipline and resist the urge to act impulsively. As Peter Lynch wisely advises, the real trick is not to follow your gut feelings, but to stick with your investments as long as the company's fundamentals remain strong. If the core story of the company stays intact, then your investment strategy should too. But once those fundamentals change, be prepared to pivot and exit before it's too late. Focus point 2. Why slow growers can be a safer bet for investors. For many investors, the high-speed, high-risk nature of fast-growing companies isn't always appealing. The fast-paced buying and selling, often driven by the desire to seize quick profits, can be overwhelming. If you're someone who prefers a more cautious approach with less volatility, then slow-growing companies might be the better option for you. Slow growers are generally established companies with steady, moderate growth that tends to align closely with the overall performance of the economy. These companies are often big, financially stable firms that have already reached a point of maturity, meaning their growth is slower, but also more predictable. Rather than experiencing rapid, unpredictable jumps in value, slow growers offer gradual, sustainable growth. One of the key characteristics of slow-growing companies is their focus on returning value to investors through dividends. These dividends typically increase over time, offering investors a regular, reliable income stream. For those looking for a safer investment, these companies can be a solid choice. However, there are precautions you must take to ensure that your investment remains stable. First, it's important to monitor the company's dividend payments closely. Ensure that dividends are being paid regularly and that the value of those payments continues to rise year after year. The consistency and growth of the dividend payout can indicate the financial health of the company. However, it's crucial to assess whether the percentage of the dividend being paid is in line with your investment. If the percentage is too low, it may signal that the company isn't fully capitalizing on its profits to reward investors. Conversely, a very high percentage could be a sign of risk, as the company might be overextending itself to offer attractive payouts, leaving it vulnerable if the market or economy takes a downturn. The beauty of investing in slow growers lies in the security they offer. Even though the growth is slow, the assurance of dividends, especially when they increase regularly, provides a degree of stability that fast growers cannot always guarantee. Slow growers are typically more insulated from market volatility, and their dividend payouts serve as a cushion during tough times, providing both income and stability. Peter Lynch, who famously managed one of the most prestigious and actively managed mutual funds in the U.S., understands the value of such steady growth. From 1977 to 1990, under his leadership, the fund achieved record-setting growth. His experience shows that slow and steady growth, backed by disciplined investment strategies, can often outperform the volatile swings of faster-growing companies. In summary, slow-growing companies might not offer the excitement of fast growth, but they do provide a level of security, regular income through dividends, and long-term stability, qualities that make them a safer bet for cautious investors. Focus point 3, Stalwarts, the balanced investment for long-term calm. While slow-growing companies offer safety and stability, and fast-growing companies promise high returns, there's a middle ground for investors who seek both security and moderate growth. Stalwarts. Stalwarts are large, well-established companies that have already proven their staying power. Unlike fast growers, they're no longer experiencing rapid expansion, but unlike slow growers, they're still positioned to outperform the general economy over time. These companies were once high-growth stars and are now transitioning into slower, steadier growth, but they haven't quite reached the level of slow growers yet. The beauty of investing in stalwarts is that they offer a rare balance. They're not growing at breakneck speeds like fast growers, but they still present solid growth potential. They are the sure banker of the stock market, providing a safer investment with less risk, especially in turbulent times. Even during recessions or economic downturns, stalwarts tend to remain resilient. This makes them ideal for investors seeking calmness and predictability in their portfolios. One of the main benefits of investing in stalwarts is that they offer a reliable way to assess the company's performance. By tracking the price of their shares and the price-to-earnings (P/E) ratio, investors can get a good sense of whether they're paying too much for the stock or if it's a good value relative to its earnings potential. Additionally, the long-term growth rate of a stalwart company serves as a valuable guide for what to expect in the coming years, making it easier for investors to make informed decisions. Stalwarts provide a clear path for long-term success, supported by a proven history of performance. They're not as agile or fast-moving as newer, high-growth companies, but their stability and resilience make them dependable choices for those who prefer a steady, less risky route to profits. In summary, stalwarts offer a sense of calm to investors. They combine the growth potential of fast growers with the stability of slow growers, making them an excellent option for those seeking reliable, long-term growth without the ups and downs of more volatile stocks. With a stalwart, investors can rest assured that their investment is backed by a strong track record and the ability to weather economic challenges. Focus point 4, the profitability of cyclical companies, high rewards, high risks. For investors willing to embrace volatility, cyclical companies offer a compelling opportunity. These companies are known for their dramatic ups and downs, with their profitability following predictable cycles. Cyclical stocks often offer some of the highest profit margins, but they come with a significant level of risk. Cyclical companies, such as those in the oil industry or military equipment sectors, depend heavily on the ebb and flow of demand and supply. Their profits are tied to broader economic conditions and global events, making them highly sensitive to market changes. For example, during a global crisis like the pandemic, the demand for oil can plummet, resulting in severe losses for companies in this sector. However, in times of economic boom, these companies can experience massive gains, rewarding investors handsomely. The key to investing in cyclical companies is understanding the volatility. While they can provide substantial returns, they also carry the risk of sharp declines in profitability. If you're investing in cyclical companies, it's important to treat them as short-term opportunities rather than long-term savings vehicles. Given their fluctuating nature, it's wise to take profits when they're available and avoid holding on to them during periods of downturn. A smart strategy for investors is to buy cyclical stocks when prices are low, such as after a downturn, and sell them when they spike. This allows you to capitalize on the cycles of boom and bust that these companies experience. By purchasing during the low points and selling during the high points, you can leverage the volatility of cyclical stocks for substantial gains. In summary, while cyclical companies can yield high profits, they require careful attention and a willingness to take on risk. By understanding the market behavior and timing your investments appropriately, buying when prices are down and selling when they spike, you can maximize your returns while managing the inherent volatility. Focus point 5, turnarounds, the hidden potential of neglected investments. In the world of investing, there's little room for hope when it comes to ventures that seem doomed. Experts often advise against putting your money into what appears to be a losing proposition, and for good reason. Investing in a company that's clearly struggling financially is risky. However, sometimes the most unlikely candidates can make an unexpected and dramatic recovery. These companies are known as turnarounds, and they can provide some of the highest returns for those brave enough to recognize their potential. Turnarounds are companies that initially seem like poor investments, often due to financial struggles, management crises, or a period of market decline. However, these companies have the ability to turn things around, typically after overcoming a major crisis or restructuring their operations. Much like cyclical companies, the value of a turnaround company may appear to be low, but with the right moves, their stock can skyrocket. These companies often share a crucial characteristic with stalwarts. They have enough financial strength and reputation to bounce back from challenging times. One of the key factors that make turnaround companies worth considering is their resilience. These companies tend to stay in business because they have the financial resources and strategy to recover. For investors, this presents an opportunity for potentially higher returns than other, more stable companies. While it requires a keen eye to spot these opportunities, a successful investment in a turnaround company can yield impressive profits. A notable example of a turnaround company is Apple Incorporated. In the late 1990s, Apple was struggling, facing major financial issues and losing market share. However, after a series of strategic moves and the return of Steve Jobs, the company experienced a remarkable resurgence, eventually becoming one of the most valuable companies in the world. For investors, identifying turnaround opportunities requires patience and a willingness to take on risk. Unlike safer bets like Stalwarts or Slow Growers, turnaround companies offer the possibility of significant rewards, but only if they manage to overcome their challenges and execute a successful recovery strategy. In summary, turnaround companies are often neglected or written off by the market, but they can present lucrative investment opportunities. These companies, if able to pull off a successful comeback, can deliver some of the most profitable returns. Investors willing to take a calculated risk and stay informed about these companies can reap the rewards of spotting the next big recovery story. Focus point 6. The dark horse of investing, asset plays, and hidden gems. While turnaround companies can offer the potential for significant returns, they also come with a high level of risk. There's always the possibility that a company, no matter how much potential it appears to have, could fail to recover and leave investors with significant losses. However, there is another type of investment that is less risky, yet equally promising: asset plays. Asset plays are the true dark horses in the market. Companies with hidden assets or untapped potential that few investors may be aware of, but which can offer massive rewards when those assets are revealed. These companies may not be in the limelight yet, but they hold a valuable resource that will eventually have a major impact on the market. Investing in these companies before their true value is recognized can lead to huge profits in the long term. An asset play refers to a company that possesses a hidden asset, often a product, resource, or service, that has not yet been fully realized by the market. These assets might not be immediately visible, but investors with the foresight and knowledge to spot them can gain a significant advantage. Once these hidden assets are revealed, through the launch of a product, an acquisition, or a breakthrough innovation, the company's stock value can rise dramatically, rewarding those early investors. A great example of an asset play is Marvel. When it was still a relatively unknown company, Marvel had a treasure trove of valuable intellectual property, including its iconic superheroes. However, it was underappreciated in the market. Then, Disney acquired Marvel, and suddenly, the hidden gem exploded into a multi-billion-dollar entertainment empire, with its characters becoming central to blockbuster movies and merchandising. Investors who recognized Marvel's potential early on, before the assets were fully realized, saw incredible returns on their investments. An asset play can be a strategic addition to any investor's portfolio, offering a valuable hedge in the event that other investments don't perform as expected. Much like holding a trump card, investing in an asset play can provide the financial upside needed to balance out other less profitable investments. Those who had insider knowledge of Marvel before its acquisition by Disney were able to cash in on the company's massive growth, reaping rewards as the entertainment powerhouse grew. In summary, asset plays are companies with untapped potential that, when revealed, can lead to major profits. While risky, they can be valuable assets in a diversified portfolio, offering a unique opportunity to profit from hidden gems before the rest of the market catches on. Investors who spot these opportunities early can position themselves to benefit from their eventual rise, making asset plays a key strategy for those looking to gain an edge in the market. Conclusion: as an investor, whether new or seasoned, understanding the nature of the companies in your portfolio is critical to making informed decisions. Stocks can be categorized into different types based on the characteristics of the companies that issue them, and this categorization helps investors know what to expect from their investments. Peter Lynch's advice reminds us that large, established companies often offer the safest but slowest returns, while smaller, faster-growing companies can provide the highest returns, but with a much higher level of risk. Thus, as an investor, it is important to conduct thorough research and focus on companies that have demonstrated consistent profitability over time. It's equally important to be cautious of companies that may artificially inflate their profits to attract investors. Although investing in long shots, such as turnaround companies or asset plays, can be highly profitable, they come with inherent risks. If you choose to invest in these types of companies, it's wise to do so cautiously, limiting your investment to only a small portion of your portfolio to reduce exposure. Relying on the advice of industry experts can also be a valuable resource, especially when dealing with companies or sectors that you're less familiar with. The key takeaway is that a proper investment should be in companies that show consistent and sustainable earnings growth. Avoiding volatile or unstable companies, those whose earnings fluctuate unpredictably, can protect you from unnecessary risk. Ultimately, educating yourself about market trends, staying informed with expert insights, and maintaining a well-researched investment strategy are the best ways to navigate the complexities of the stock market and secure long-term financial success. In this audiobook, we explored valuable insights from Peter Lynch's investment strategies, offering listeners practical wisdom for navigating the stock market. Here's a summary of the key focus points. Understand the categories of stocks. Stocks are categorized into fast growers, slow growers, stalwarts, cyclical companies, turnarounds, and asset plays. Each category carries its own risk and reward profile, making it crucial for investors to align their choices with their financial goals and risk tolerance. Fast growers, small companies with rapid growth but high risk. Caution is necessary to ensure sustainable growth. Slow growers, established companies offering steady returns, often through dividends with lower risk. Stalwarts, big, reliable companies that are not growing quickly but offer consistent returns and stability. Cyclical companies, businesses whose profits fluctuate with economic cycles, offering high returns but with significant risks. Turnaround companies, firms that have struggled but can rebound dramatically, offering substantial potential rewards for risk-tolerant investors. Asset plays. Hidden gems or undervalued companies with untapped assets that can skyrocket once revealed. Recommendations. Do thorough research. Always assess a company's financial health and growth potential before investing. Diversify your portfolio. Spread your investments across different types of companies to reduce risk while aiming for growth. Monitor earnings growth. Ensure the companies in your portfolio have consistent, sustainable earnings growth. Be cautious with high-risk investments. Invest a small percentage of your portfolio in high-risk opportunities like turnarounds or asset plays. Listen to experts. When in doubt, trust the advice of experienced investors and market analysts. This audiobook has provided valuable insights into various investment strategies and how to approach the stock market intelligently. Understanding these key principles will empower you to make more informed decisions, whether you are new to investing or looking to refine your strategy. Thank you for your time and interest. We truly appreciate your time in listening to this audiobook. Your interest in learning and self-improvement is commendable. If you found this audiobook helpful, please like, subscribe, and share with others who could benefit. Your support helps us continue creating valuable content. Enhance your English with every listen. Remember, the more you listen, the better you speak. This audiobook isn't just about investing. It's also a fantastic resource for improving your English language skills. Keep engaging with the content, and you'll find that your fluency and understanding will continue to grow. Thank you once again for listening, and we hope you continue to benefit from these insights in your personal and professional life.